As the European markets are closed, we can see Pacific Textiles Holdings Limited, trading on the Frankfurt Exchange under the ticker WHE, finished its last session on November 7th at 10 p.m. GMT+1 at €0.14. This represents a drop of 2.05% for the day. Now, the immediate expectation when you see a price like €0.14 is that you are looking at a distressed, forgotten microcap, perhaps a shell of a company teetering on the edge of irrelevance. The reality, however, is that this Frankfurt-listed stock is a ghost. It is an extremely low-volume secondary listing that tells you absolutely nothing about the actual company. The real story and the real trading happens on the other side of the world on the Hong Kong Stock Exchange, under the ticker symbol 1382. And that company is not a €0.14 footnote. It is a significant manufacturer with a market capitalization of nearly 2 billion Hong Kong dollars. The data shown for the Frankfurt listing, specifically the PE ratio and div yield being blank, is perhaps the most misleading part of the picture. This isn't a company with no earnings or no dividend. It is a company that, on its primary exchange, trades at a PE ratio of around 12 and pays a staggering dividend that has recently yielded over 8%. The expectation is a bankrupt penny stock. The reality is a high-yield, profitable industrial company that is currently facing intense macroeconomic pressure. This is the core tension for investors right now. The general belief is that the entire textile and apparel industry is in a deep freeze. We see it in the commodity markets. Cotton futures have been weak, not because of a supply glut, but because of a severe drop in global consumption. Consumers, squeezed by inflation and economic uncertainty, are cutting back on discretionary items like new clothes. This narrative perfectly explains why Pacific Textile's Hong Kong-listed stock, 1382, is trading near its 52-week low of around 1.08 HKD, currently sitting at about 1.44 HKD. The market is pricing in a protracted downturn. But this is where we must challenge the common ground. Pacific Textiles is not just a generic maker of t-shirts. This company is a high-tech manufacturer of specialized, high-performance knitted fabrics, both cotton and synthetic. Their primary business model is built on long-term, large-scale relationships with some of the biggest apparel brands in the world. Most notably, they are a key production partner for Uniqlo, the global giant owned by Fast Retailing. This means their fortunes are not tied to the whims of the fast fashion cycle, but to the strategic, high-volume orders of a global behemoth. Their production bases in China and Vietnam place them at the very center of the world's manufacturing supply chain, which is both a strength in terms of scale and a risk in terms of geopolitical friction. The recent stock movement on the Hong Kong Exchange has been, to put it mildly, discouraging. The stock has bled approximately 10% over the last year and is stuck in a clear short-term falling trend. Volume on its main exchange is healthy, often seeing millions of shares traded, which confirms that the Frankfurt listing is irrelevant. The institutional activity is what we must focus on. This is not just a retail-driven stock. Data from its US-based over-the-counter ticker shows significant institutional holders like Dimensional Fund Advisors and Transamerica. These are not fast money hedge funds. These are large, value-oriented institutions. And they are almost certainly in this stock for one reason: that massive dividend. The company has a history of paying out a substantial portion of its income to shareholders. But this brings us to the central risk, and it is what the short sellers are looking at. While there isn't a massive coordinated short attack underway, the data shows a notable level of short interest. Fintel reports a borrow rate of around 1.5% and roughly 10 million shares available to short. This isn't a panic-inducing number, but it is a clear sign that a contingent of smart money is betting against the stock. Their thesis is straightforward and compelling. The macro headwinds are real. Weak consumer demand in Europe and the US, combined with intense competition from lower-cost synthetic fibers like polyester, is compressing margins. The company's own financials show this pressure. In its last semi-annual report, net income showed a sharp decline. The critical issue is the payout ratio, which has been hovering near 100%. This means the company is paying out nearly every dollar it earns in profits back to shareholders as a dividend. This is fantastic for income investors, until it is not. A payout ratio this high is a red flag. It leaves no room for error, no capacity for reinvestment, and no cushion against a bad quarter. The short sellers are betting that the next earnings report, or the one after, will show profits have fallen to a point where the company simply cannot maintain this 8.5% yield. They're betting on a dividend cut, and if that happens, the primary reason for holding the stock vanishes, and the share price could fall significantly further. What's your take on that 8.5% dividend yield? Is it a sustainable value trap or a solid income play in a beaten-down sector? Let me know in the comments. So how can an investor navigate this? First, you must ignore the Frankfurt ticker, WHE. It is a data illusion. Your entire focus must be on HKEX 1382. Second, you need to find and monitor the short interest data for the Hong Kong listing. This can be found on data platforms like Fintel or by tracking borrow rates through interactive brokers. A sudden spike in the borrow rate from 1.5% to, say, 10% or 20% would be a massive warning sign that short sellers are aggressively increasing their positions, likely ahead of what they believe will be bad news. Third, you must track the company's financial releases directly from the Hong Kong Stock Exchange. The single most important date on the calendar for this company is its next earnings release, which is expected around November 28th. This report will be the moment of truth. Analysts and investors will not be looking at revenue as much as they will be looking at net income, and most importantly, any guidance from management on the dividend policy. Any language that hints at reevaluating or adjusting the dividend to reflect market conditions will be seen as a precursor to a cut. The company's past performance is a story of a stable, profitable industrial player that became a darling for income investors. For years, it successfully navigated the complex supply chains of its major clients like Uniqlo. It even weathered controversy, such as reports from advocacy groups back in 2015 regarding working conditions, and worked with its partners to implement improvements. It has proven to be a resilient operator. But the current challenge is not operational. It is macroeconomic. It is about a global consumer who is simply buying less stuff. The bull case for Pacific Textiles is that this downturn is cyclical. The argument is that the market has oversold the stock, that its long-term relationship with Uniqlo provides a baseline of demand, and that as inflation eases and consumer confidence returns, orders will pick back up. In this scenario, the company's profits will stabilize, the dividend will be secured, and investors who bought in at these low levels will lock in an 8.5% yield and enjoy significant capital appreciation as the stock re-rates higher. Bear case, as championed by the shorts, is that this is a structural decline, not a cyclical one. The risk is that major clients like Uniqlo, facing their own pressures, will diversify their supply chains away from China-based manufacturers or use the weak demand environment to permanently squeeze margins. In this reality, Pacific Textile's profitability will not recover to its previous levels, the dividend cut is inevitable, and the stock is a classic value trap. It looks cheap, but it is cheap for a very good reason. Comment below if you think the connection to major brands like Uniqlo provides a safety net for Pacific Textiles, or if it's a liability in a downturn. Looking forward, the entire investment thesis hinges on the forthcoming earnings report. That is the catalyst. If the company beats expectations or even just meets them while strongly reaffirming the dividend, you could see a significant short covering rally, as those betting on a cut are forced to buy back their shares. If the company misses, and worse, cuts the dividend, the floor will fall out. The expectation set by the €0.14 price was a dead company. The reality is a 2 billion HKD profitable high-yield company, but the new expectation set by the bears is that its dividend is on the verge of disappearing. The reality of its financials in the next report will determine if it is a historic buying opportunity or a falling knife.